Adobe tried to buy Figma for $20 billion, and regulators laughed them out of the room. By the end of this video, you'll understand exactly how a design tool built by a college dropout became the most strategically terrifying software company in Silicon Valley, and why the story of Figma will permanently change how you think about building a business. Whether you're a founder, an investor, or just someone who uses the internet, this one matters. Adobe tried to buy Figma for $20 billion for a company that had never turned a profit. That deal was announced in September 2022, and immediately, every business journalist in America started asking the same question. Why would the most dominant design software company on the planet pay that much for a competitor it could have simply crushed? The answer to that question is the entire story. And later, I'll reveal the one strategic miscalculation Adobe made years earlier that essentially forced their hand. Buckle up. Dylan Field was a junior at Brown University when he got the Thiel Fellowship. If you've never heard of that, here's the quick version. Peter Thiel, the PayPal co-founder and venture capitalist, runs a program that pays promising students $100,000 to drop out of college and start a company. It sounds insane. It is a little insane. But Field took it. He was 20 years old, had a vague idea about building something in design software, and convinced his college friend Evan Wallace to join him. Their original pitch? They wanted to build a tool that would let people design interfaces directly in a web browser. No download, no install, real-time collaboration baked in from day one. In 2012, that idea was so ahead of its time that most investors thought it was science fiction. The browser simply wasn't powerful enough to run that kind of software. But Field and Wallace had a theory that browsers were about to get dramatically more powerful, and if they could build the infrastructure before anyone else, they'd own the category. And that changes everything. Here's the part nobody talks about. Figma's early years were a grind that would have broken most founders. Field and Wallace spent nearly 4 years in development before launching a public beta in 2016. 4 years. That's not a pivot or a stumble. That's a near-death experience in slow motion. They burned through their initial funding, raised more from investors including Index Ventures and Greylock Partners, and kept rebuilding the core engine of the product. Why? Because the browser technology they needed, specifically WebGL, which allows complex graphics rendering inside a browser, kept evolving, and they had to evolve with it. Every time they thought they were close, the target moved. There were moments, according to people close to the company, where it genuinely wasn't clear they'd survive. And here's a fact that still surprises most people in the industry. Figma reportedly had fewer than 10 employees when they finally launched their public beta. 10 people building software that would eventually go head-to-head with Adobe, a company with over 25,000 employees and $17 billion in annual revenue. When Figma went public beta in 2016, the design community didn't exactly throw a parade. The tool was slower than Sketch, which was the dominant design app at the time. It had fewer features. It looked like a work in progress, because frankly, it was. But there was one thing Figma could do that nothing else on the market could do. Multiple people could work on the same design file simultaneously, in real time, from different computers, anywhere in the world. No syncing, no exporting, no emailing files back and forth. You just sent someone a link and they were in your file, live, right now. Now this might sound simple. It was not simple. This was Google Docs for design, and in 2016, that didn't exist. Professional designers had been working in isolated silos for decades. One designer, one file, one computer. The collaboration model in design had never fundamentally changed. Figma didn't just add a feature, they rewired the entire workflow. A Harvard Business Review analysis of design tool adoption later cited Figma as a textbook case of what they call workflow lock-in, where a product doesn't just replace a tool, it replaces a behavior. And once you change how people work, you have something far more powerful than a product. You have a habit. That changes everything. Figma's secret weapon wasn't designers, it was product managers and engineers. Think about how design software had always worked. Designers used it, and then they shared outputs with everyone else. PDFs, PNGs, static files. Everyone else was a passive consumer of design work. Figma's real-time collaboration model meant that for the first time, a product manager in Chicago could open the same file as the designer in San Francisco and leave a comment directly on the mock-up. An engineer in Austin could inspect the exact spacing, font size, and color value without asking anyone. The whole team was now inside the design file. This was massive, because here's what that means for sales and adoption. You don't need to convince one designer to switch tools. The entire product team just got pulled in automatically. Figma had accidentally invented a viral distribution model built directly into its product. Every time a designer shared a Figma link with a non-designer, that non-designer became a potential Figma user. By 2019, the company had reportedly grown to over 1 million users without spending significantly on traditional sales and marketing. 1 million users, mostly through word of mouth and link sharing. And they were still not profitable. Here's the strategic miscalculation I promised you at the start. In 2016, the same year Figma launched its public beta, Adobe was busy with something else entirely. They were in the middle of one of the most successful business pivots in tech history, transitioning their entire product line from one-time software purchases to a monthly subscription model. Adobe Creative Cloud. And it worked. Revenue went from roughly $4 billion in 2012 to over $11 billion by 2019. Wall Street loved it. The stock price tripled. Adobe looked like geniuses. But here's the thing. That pivot consumed every ounce of executive attention at Adobe for nearly a decade. They were so focused on defending and monetizing their existing customer base that they missed the behavioral shift happening underneath them. While Adobe was perfecting the business model around Photoshop and Illustrator, desktop tools, the entire next generation of designers was learning to work in the browser. The shift wasn't just about features, it was about where work happened. And Adobe, despite having thousands of engineers and billions in R&D budget, did not build a serious browser-based design tool. Not for years. Frankly, that's one of the most expensive strategic blind spots in modern tech history. Forrester Research estimated that by 2021, Figma had captured over 75% of the professional UI and UX design market. 75%. From zero. In 5 years. By 2021, Figma raised its Series E funding, rounded a $10 billion valuation. $10 billion. For a company that was still not profitable. Now, before you roll your eyes at another overvalued Silicon Valley unicorn, let me give you the context that actually matters. Figma's annual recurring revenue, ARR in industry terms, had crossed $400 million by that point, growing at over 100% year over year. In SaaS investing, that kind of growth at that scale is almost unheard of. The investors weren't buying a fantasy, they were buying a growth rate. And the math they were running was simple. If Figma keeps this trajectory for 3 more years and hits $1.5 billion in ARR, The company is worth $15 to $20 billion on public markets. That's not speculation. That's the standard revenue multiple for high-growth SaaS companies on NASDAQ. The reason Figma had never turned a profit was strategic, not accidental. They were deliberately reinvesting every dollar of revenue back into engineering, sales, and international expansion. This is a well-documented playbook. Amazon ran it for 20 years. Salesforce ran it for 15. In the venture capital world, choosing growth over profit at this stage isn't a red flag. It's the whole point. And what nobody was saying out loud, but every investor knew, was that Figma had something worth far more than revenue. They had switching costs that were almost impossibly high. Here's what switching costs mean in plain English. A Figma file isn't just a file. It's a living document connected to a team's entire design system. Shared components, brand libraries, prototype links, comment threads, version history. A company that's been using Figma for 2 years has thousands of these files, all linked together, all tied to team workflows, all referenced in engineering handoffs. To switch to a competitor, you don't just download new software. You rebuild every component library from scratch. You retrain every designer, product manager, and engineer. You re-establish every workflow. You break every link that's ever been shared internally. The cost isn't financial, it's operational. And for a company with 50 designers and 200 engineers, that operational cost is enormous. This is what Figma built, without most people noticing. Not just a great product, an organizational dependency. And here's the jaw-dropping part. According to data published by product analytics firm Amplitude, Figma users in enterprise accounts open the tool an average of 9 times per day. 9 times. That's not a design tool, that's infrastructure. And once something becomes infrastructure inside a company, the conversation stops being, should we use this? And starts being, we cannot function without this. That's the most powerful position any software company can occupy. Now forget everything I just said, because what happened next changes the whole story completely. In September 2022, Adobe announced it was acquiring Figma for $20 billion, half cash, half stock. It was the largest acquisition in Adobe's history, larger than anything else in design software history. And the reaction from the design community was immediate and visceral. Designers flooded Twitter and Reddit with one word: betrayal. Figma wasn't just a tool to these people, it was the independent, scrappy alternative to Adobe's expensive, locked-in ecosystem. The fact that Adobe was now buying it felt like the Death Star absorbing the rebellion. Dylan Field put out a long statement explaining that staying independent would be the right move long-term, and that Adobe was committed to keeping Figma separate. Not everyone believed him. And here's the critical detail most coverage missed. Adobe was paying a 50x revenue multiple on Figma, 50 times annual revenue. For context, the average software acquisition on Wall Street happens at 5 to 8 times revenue. Adobe was paying 6 to 10 times the normal rate. Why? Because they'd calculated that if Figma went public and ate further into their market, the damage to Adobe's stock price and market position would cost far more than $20 billion. This wasn't an acquisition. It was a defensive war move disguised as a press release. The European Commission and the UK's Competition and Markets Authority spent over a year investigating the Adobe-Figma deal. Their concern was straightforward. Adobe was the dominant player in creative software. Figma was the dominant player in design collaboration. Merging them would create a monopoly so complete that no startup could realistically compete. In December 2023, Adobe and Figma walked away from the deal. After 15 months of regulatory limbo, $1 billion in termination fees paid by Adobe to Figma. Let that sink in. $1 billion just for calling it off. The acquisition was dead. And here's the part that's almost poetic. Figma walked away from the collapsed deal with $1 billion check, its independence intact, and a market validation that no amount of press releases could have manufactured. The failed acquisition essentially confirmed in writing from regulators in two of the world's largest markets that Figma was so dominant and so strategically important that allowing it to be absorbed would harm competition across the entire industry. That's not a bad day at the office for a company that started in a college dorm room. And the story wasn't over, not even close. In June 2024, Figma confidentially filed for an IPO. Going public, the company that started as a Thiel fellowship project, that spent 4 years building in the browser, that beat Adobe at its own game and walked away from a $20 billion acquisition with its independence and a $1 billion consolation prize, is now heading to the public markets. Analysts at Goldman Sachs and Morgan Stanley have estimated Figma's IPO valuation could range between 12 and 15 billion, which is actually lower than the $20 billion Adobe tried to pay. And that's not a sign of weakness. That's the public market being realistic about where we are in the tech valuation cycle post-2022. Here's what matters more than the IPO number. Figma's current revenue trajectory, customer base, and product roadmap suggest a company with decade-long staying power. They've launched Figma Dev Mode, a feature specifically built for engineers that further entrenches the tool in non-designer workflows. They've expanded into FigJam, a collaborative whiteboarding product competing directly with Miro and Lucid. And they're pushing hard into AI-assisted design features that could theoretically let non-designers build production-ready interfaces without professional help. That last one is either the most exciting or most terrifying development in design software in 20 years, depending on which side of the screen you're on. Can Figma actually become profitable? Because here's the uncomfortable truth that doesn't make it into the press releases. Figma has been operating at a loss for over a decade. Its cost structure, engineering talent in San Francisco, international sales teams, infrastructure costs for real-time collaboration at scale is enormous. And while $400 million in ARR sounds impressive, it costs a lot to serve thousands of enterprise clients at the quality level Figma promises. The company will face immediate pressure from public market investors who don't have the patience of venture capitalists. Quarterly earnings calls, analyst coverage, profit and loss scrutiny. The same dynamic that destroyed the valuations of Lyft, Snap, and Peloton after their IPOs, the gap between growth story valuation and profitability reality, is a very real risk for Figma. Dylan Field has said publicly that Figma has a clear path to profitability. But so did WeWork. So did Uber for years. The difference is that Figma's core product is genuinely mission-critical to its customers in a way that those companies' services never were. And that distinction matters enormously when the economic cycle turns. Here's what Figma actually teaches us. It's not a story about design software. It's a story about timing, patience, and the terrifying power of rebuilding a behavior. Dylan Field didn't build a better version of what existed. He waited 4 years in a dorm room and a San Francisco office for the technology to catch up to a behavior he believed people would eventually adopt. Real-time collaboration wasn't a feature Figma added. It was the founding thesis. The entire product was architected around a future he was betting would arrive. And when it did arrive, every competitor was stuck. Adobe couldn't just add real-time collaboration to Photoshop. The entire architecture of that tool was built for single-user, single-file, desktop use. Rebuilding it would have taken years and broken thousands of existing workflows. They were trapped by their own legacy. This is what Clayton Christensen at Harvard called the innovator's dilemma. And it's one of the most cited frameworks in business school, with good reason. The bigger a company gets, the harder it is to cannibalize your own product before a competitor does it for you. Adobe knew Figma was coming. They saw the threat, and they couldn't move fast enough to stop it, because moving fast enough would have required them to hurt themselves first. Figma's rise wasn't an accident. It was a structural inevitability, and that changes everything, from a $100,000 Thiel fellowship check to a $10 billion company that forced Adobe into the single most expensive defensive acquisition attempt in design software history. From a 4-year development grind that most founders would have abandoned to a product used by over 4 million designers, product managers, and engineers every single day. From a college dorm room at Brown University to confidential IPO filings on Wall Street. That's the arc. Not because of some secret hack, not because of viral marketing or influencer deals or a perfectly timed product launch, because 2 people picked a behavior, the way designers work, and decided the world was going to change, and they were going to be the ones waiting on the other side when it did. The Adobe acquisition collapse wasn't a failure. It was a coronation. And the IPO isn't an exit. It's the opening act of something that might be far larger than a design tool. Phase 1. Synthesis. Here's what I want you to take from this story. Figma didn't win because they were smarter than Adobe. They won because they had the patience to build for a world that didn't exist yet, and the product discipline to make collaboration the foundation, not an add-on. Every business decision after that flowed from that single founding insight. The $10 billion valuation, the regulatory block, the $1 billion termination fee, all of it traces back to one bet made by a 20-year-old in a dorm room who believed the browser would eventually be powerful enough. That's what real strategic vision looks like. Not a mood board, not a mission statement. A specific, testable belief about how human behavior is going to change. And the willingness to build your entire company around it before anyone else believes you. Phase 2. Final statement. The companies that define the next decade won't be the ones that build the best product for the world as it is. They'll be the ones that build the right product for the world as it's becoming. Phase 3. Closing. Figma started as a bet on the future, and the future showed up. If you found this valuable, follow the channel for more stories like this. Thanks for watching.